This is the Daily Market Rundown live from the Tradelo trading floor. Some highlights from today's show. US 30-year yields trade to the highest levels since 2008. OPEC announces some more oil supply, and PMI data is in focus around the world. Hello, good day, welcome. Let's get stuck straight into it. Looking across the board at Europe, we can see it's been a follow through from the US session. We saw US closing relatively weak post the US 20-year auction. That followed through into Asia. We can see Asia is down across the board. And then, of course, we're now finally seeing a down day in Europe, which is something we have not seen for the last 6 weeks. So we are seeing a relatively big down day. Now, relatively big, I say that, in a sense of we've not seen a DAX down 1%. Or a CAC down 1% for the last 6 weeks. But do keep in mind, of course, we are 27% higher than when we were 6 weeks ago. So it's very much just giving back some of that overextended move, some of that overbought move. Now, key to sort of a lot of this weakness is all being driven, of course, by our first topic, which is what's going on in the yield space. Now, we do need to, of course, start by just discussing what the heck is going on, because I think the newspapers have got this wrong, as they usually do get it wrong, in a sense of they were leaning on the fact that it was a weak 20-year auction. It was not a weak 20-year auction. It was an auction that was pretty much in line with averages. Sure, there was a bit of a tail, but indirect bidders were very, very strong at 69%. And the reality is that I think if you're going to sort of put it on anything, what happened is there's a little bit of sensitivity in the bond market at the moment. We saw a little bit of a tail, but perhaps there was this general idea that with a 5% coupon, there shouldn't be a tail. Perhaps there should have been somewhat less of a tail, even though it wasn't a significant tail. So I think that's just the way to look at it. I think it's sort of this typical journalism approach where they see the market move and they say, well, therefore it must be the auction. Okay, it's not quite the case. Now, I think the reason I'm mentioning it is because it matters a great deal. Had it been obviously the auction, had we had a weak auction, you would of course seen follow through on the 30-year today. You'd see us trading well above 510. In fact, you would see us trading back towards that 518 level, which is the highs from 2023. The point I'm trying to make here is that I suspect we're going to get a little bit more two-way trade in the 30-year today, and obviously I do think that 518 gets tested. Now, what that means for markets is for the first time yesterday we actually saw the equities and the correlation with equities and the higher yields start to become quite positive. In other words, higher yields lead to a sell-off in the equity markets. In other words, bond sell-off, equity sell-off. Okay, now it's the first time we've seen this in some time, like I've been sort of banging on about it the last couple of sessions. That SPY chart at some point was going to reattach itself to that correlation, and seemingly it did do that exactly yesterday. Now, what that means for us as traders, particularly day traders, is when these sort of correlations become sensitive and strongly positive correlation, we need to latch onto it quicker rather than later. In other words, when they become positive correlation, that's when the opportunity scope is best for us as day traders. In other words, if we take out yesterday's 30-year low, don't be surprised to see the S&P take out the overnight lows and perhaps extend it away towards that gap, which we'll talk about in a minute. Okay, that's the key. As you can afford to be aggressive now, given that correlation has now attached itself. Now, what's going on, and what I perhaps think is more important and what's driving this move in high yields, is again something I've been talking about quite a lot now over the last 4, 5, 6 sessions. It's this idea that the Trump administration thinks that they can just run a 6 to 7% deficit, against the GDP for the next 2 years. Okay, I think there's this idea from the Republican side that they can run a 7% deficit because it will somehow magically create 3% growth. And this is ultimately what the market's saying. The market's saying, no, we're not going to accept another 2 years of lavish spending, of this deficit spending, particularly when we have a very strong US economy, and particularly when there's growing risks with regards to tariffs. Okay, I think bond investors are now sitting up saying, unfortunately, we want more risk premium. If you're going to run the economy hot and you're going to run inflation above 3% and you're going to take on the rest of the world in terms of tariffs, we're not going to accept these yields, and we want higher yields. And that's exactly what's going on. It's this sort of vote against this big, beautiful bill. And it's very similar. One of the things you want to go look at is obviously what happened to Liz Truss. back in 2023 when she tried to force through a budget where it was this exact same idea of, we'll deficit spend, but we'll do so because we're going to create this magic growth. Okay, and she got absolutely punished for it. The pound got sold very aggressively as well as gilts. Okay, we have a very similar setup here where we saw yields pushing higher over the last 3-4 sessions. At the same time, we saw the dollar getting sold as well. Okay, so we are starting to stage that almost identical setup to what we saw from a Liz Truss. Now, a number of things still have to happen, and that's why I think the market's not necessarily overplaying its hand yet. Okay, obviously what's going on is there's a passage through the House. It seems like they will get that through the House, but then it of course has to go to the Senate. Okay, now the Senate will take its time on this, and of course they can make changes, but ultimately this is kind of a case of, as it gets passed along, the market will start to become very, very concerned based on the odds of it passing the Senate in its current format. Okay, and that's kind of how you have to think of it. You have to think of it at a probability standpoint. If they pass it, if it was passed exactly as it is now, as it's been passed on the floor, ultimately you will get quite a significant sell-off in bonds and as a result equities. Okay. However, if there are significant cuts to spending, perhaps some of the the other income tax and corporate tax ideas are scaled back a little bit, fine. You may still get a little bit of higher yields, but perhaps to a lesser degree. Okay. And so this is going to become a game of how much additional deficit is going to get passed. And once the market really understands how much is actually going to get passed, I do suspect we're going to see much, much higher yields. Now, I was talking to another trader this morning about how high yields go. Well, the reality is it's not necessary, this whole idea of debt to GDP, it's not problematic in the short term. Okay, so it's not necessarily a problem today or next week or even this year. Okay, but it is a problem long term. Okay, so this is something that can blow up, but it's not necessarily going to blow up today, tomorrow. And so that's why you always just have to be very alert to this idea that, yields at 5.10, yes, they are problematic. But ultimately, we're going to need to see yields at 5.50 and perhaps 6% in the 30-year. And that then, fine. All bets are off. That will tip the US economy into a recession, guaranteed, like I said yesterday. And you will see the S&P sub 5,000. Okay, that is, if you're going to ask me what's perhaps a play this year that day traders can do very well on, that's it. Okay, if we get above 518 in the 30-year, all bets are off. We're going back down to 5,000 pretty quick. Okay, now let's get on and talk about the key thing. I think one of the things that's sort of interesting is the CBO is talking about this idea of even with the plans that the Republicans are talking about, and when factoring in the growth they think that's going to come from it, there's still going to be 1.9 trillion over the next 10 years. Okay, so in other words, this idea that the administration has that ultimately they can spend, and it will bring down the deficit because they're going to grow at 3% it's just laughable. Okay, and that's what the market is telling us. The market's telling us this is a bit of a joke. This idea that you can just grow, like a magic tree, printing money, it just doesn't work that way. Okay, so just keep an eye on yields. That's the key takeaway. Now there is that chart. What you can see, this is of course a line chart. So it was the highest close since 2023, but don't forget, of course, if you go look at a bar chart or a candlestick chart, 518 is the highest print that we traded back in 23. Okay, so there was a very, very strong reversal up at those 518s, and I do suspect we'll go and test it in the near term, but I also suspect that we are going to struggle up there initially. Okay, well, one thing to know about bond yields in general, particularly the 30-year, is they need very, very, very big fundamental conviction to move. Okay, in other words, if this deal does get passed and suddenly we see very hot inflation prints next month, fine. Then there's every reason to go above 518 because now the market has very strong fundamental conviction to push. All right, but until we get that strong fundamental conviction, I do suspect, particularly because we're a little bit overbought, that we may just settle into a higher range for now. Okay, now one thing to note. Okay, go and have a look at ultimately this breakout from 2022. This is when we start to see the US economy reaccelerate into, of course, late 2023. And we can see as a result of that, we had that very decent breakout in the 30-year. Now, what I want to point to is it's a very similar setup in, if we look at how the 30-year was trading around that 200-day average, we can see that it extended itself into that high. It then backed off initially. And then it started this process of just grinding before it then went up the page. Okay, I suspect we might get something very, very similar, whereas we just sit now in this very tight range above 5%, just grinding, and then at some point you're going to get a catalyst, maybe a data point, maybe a Trump comment on the big beautiful bill, maybe a tariff comment, something along those lines, and it's going to catapult its way above that 518. Okay, and like I said, the markets are now sensitive. The correlation is there, which means that SPY is going back down to that 500 pretty quick. Okay, don't forget, I appreciate this has felt like the most bullish market move in the world. But if you've traded, 2020, if you've traded 2022, if you've traded this bounce, if you've traded these bounces that we always seem to get, they feel immensely frustrating. Okay, you sell what are key levels, and yet the market just does not respond to them. The reality is markets don't go down off of levels. Markets go down via the elevator. Okay, it's a case of everyone who was short got stopped out. Everyone who wants to buy is now bought. And ultimately, once the market turns, we only have sellers in the market. There is no bid, there is no liquidity, and we find our way down the page pretty fast. Okay, this is how you have to trade the market in the current era. It's very much a case of once it latches onto a new theme, we just nosedive. Okay, and we've seen this time and time again. Go look at some daily candles. You'll see whenever these tops form, they do just drop. Like I said, the market likes to catch the elevator down. Now, US Eurozone PMIs, of course, were in focus this morning. I think this is interesting, and I think it's interesting for a very good reason. We know the tariffs are in play. Okay, what we don't know yet is the implications for hard data. But I think what we're starting to see, whether you look at UK PMI, now European PMI, and I suspect the market PMI is going to show the same thing from the US today, is that we are seeing the uncertainty hit manufacturing and services data. That is the key. Now, everyone's kind of looking at this going, when is ultimately the soft data going to hit the hard data? I think you're seeing it. And that's why this headline where it says, Eurozone May business activity surprisingly, Connor. Why is it a surprise? We've hit the world with tariffs with a significant amount of uncertainty. We don't know what's coming. We just know there's 90 days. And yet the headline here says surprisingly. No, there's nothing surprising about it. And you shouldn't be surprised with these significant misses, because guess what? If you're running a business, whether it's a service business, whether it's a manufacturing business, the reality is you've scaled back. The reality is you are concerned because you just do not know what comes next. Okay? And this is the case across the world. We saw it, of course, in the Japanese PMIs. Okay, they missed as well. We saw it now in the Eurozone PMIs, and I suspect we're going to see the same thing out of the UK. And we'll talk a little bit about that data point, the US later on today, and we'll talk about the implications of that. The point is that we are now starting to see this hit the hard data. Okay, what that means is recession odds are going to start to rise. What's going to happen to those equities? Like I showed you on that SPY chart, we're going to catch that elevator down. Okay, this is the key theme now. We've turned. We turned already last week. It doesn't feel like we've turned, but don't forget, the VIX never got below 18. Okay, now if you go back, the VIX last year was averaging around 15. We've changed in terms of regime. A normal VIX of 18 might not feel like the markets are nervous, but guess what? A VIX of 18 means we can suddenly find our way back to 24 and 30, which is why we catch that elevator down the page. Okay, now, OPEC's come out, and this is not necessarily news, but it is something to just sort of revisit. They've announced they will look to increase another 411,000 barrels. Now, of course, oil sold off, and I kind of looked at it and I was like, that's interesting. And of course, if you look back when they announced the 2.2 million increase, oil effectively staged, what was a 10-12% drop on that. Okay, so that was new news. But this 411,000 barrels is not new news. Why? Because they've told us they're going to bring that 2.2 million barrels back by November. Okay, so all they're telling us now is the sequence in which they're going to do it. Now, where there is potential market moving news is ultimately they've put this number of 411 out there on purpose. So the question is, can they actually afford to cut 411,000? All right, so they put it out there, they feel the market. You can see oil's unchanged on it, which means, guess what? You're going to get 411,000 more barrels. Doesn't mean anything for the price of oil? No, absolutely not. This is in the price. Okay, the market already priced an additional supply of 2.2 million barrels, of course, by November. All right, so what would be market moving is if all of a sudden they came out and said, well, we're only going to do 100,000 barrels. Why is that market moving? Because it then suggests that OPEC might not get to that total of 2.2 million by November. Okay, it may take them longer to bring that supply back online. What does that mean? That means perhaps a little bit more support for the price of oil. That being said, there is, of course, we know that they increased production by 960,000 barrels, and they unwound around 44% of the 2.2 voluntary cuts that was done in 2022. But the key takeaway is this is the move. Okay, apologies that let me move that away for you quickly. What you can see is that was the move. That was when they announced it. We were trading up at 70s. We dropped to 55s. We've bounced. Okay. The key here, as you can see, we're below that 50-day moving average, but we have priced in this news. And so what I suspect oil does is it just sits in this range until further notice. Okay. 55s up to 63s is probably where we're going to sit for the next couple of months. All right. Until we get new information, whether that's a recession or whether that's a growth rebound, until we get some new fundamentals, oil is stuck in this range. Okay. That being said, there was a leading indicator, and I talked about this over the course of the last couple of sessions, which was pay attention to the junk bonds. Okay, junk bonds have done nothing. Junk bonds have been stubbornly sitting up here doing absolutely bugger all. Okay, now credit spreads are always something to watch out for. Why? Because everyone was talking about this idea that the S&P bounce was very, very obvious if you just looked at those credit spreads. Okay, the point is that yesterday the junk bonds were leaning to the downside. Hence why Russell was the big underperformer yesterday. Okay. Now, what is interesting, notice we have drawn that red line. That red line is effectively the low of, pretty much May. Okay, obviously if you exclude this out, but that was a low point for a good 3 weeks. Okay, the key is we started filling in that Monday gap already. Okay, now why does that matter? And this Monday gap was obviously when China and the US agreed to talk some more. The point is that the gap started getting filled out yesterday, whereas if you look at the S&P, look at the Nasdaq, they're still well above that gap. Okay, so why does this matter? Because what it suggests is the S&P is probably going to go and continue to fill that gap to the downside. Okay, so keep an eye on junk bonds. I suspect they fill that gap today, and I suspect the S&P's probably got around another 2 to 3% to the downside, and that's likely to continue over the next couple of sessions. Okay, now our recession watch, we've been talking about this, and we're going to keep talking about this. I'm going to keep showing you this chart. We now made a new steeper 210s. We're up at 58 basis points, and I've called it the BB bill. In other words, if you look at when the steepening started, we're about 14 basis points higher. When did it start? Well, it started when the big beautiful bill was introduced. In other words, the market is telling you exactly what it thinks of the big beautiful bill. It thinks it's going to be fiscal expansionary, it thinks it's going to be problematic, and ultimately it's going to force the hand of the Senate to change the bill. Okay, that's ultimately what happens now. Yields are going to spike, the Senate's obviously going to have to backtrack. That's how this works. That's how it plays out. You're probably going to see 30 years at 5.5%. You're probably going to see some panic. You're probably going to see the VIX a lot more higher. You're going to see the dollar a lot lower. Gold's going to be up the page. Hence why Bitcoin is flying. Okay, Bitcoin's at record highs, and not because of speculatory, we're going to the moon. It's flying because everyone's trying to bet or hedge against the dollar. Okay, that is ultimately what we're seeing. Everything is rallying against the dollar right now. Okay, keep an eye on that. I suspect we're going to continue to see this steepen. So long as that big, beautiful bill keeps passing its way, so long as they keep talking about deficit spending, ultimately we are going to see those curves steepen. And then finally, our data point for today, this is the US flash PMI. One to keep an eye on for the simple reason that I do expect we're probably going to trade sub 50 today. Now, if we go in below sub 50, you can see that's the first time since September, December 2022, and that is going to create a little bit of concern. And I suspect effectively that good data or bad data today is perhaps bad for equities. Why? Well, because if you get a good data point, let's say we do beat to the upside, those bond yields are obviously going to perhaps move a little bit higher on the day. Why? Well, because we're seeing an accelerating economy, plus the inflationary concerns, plus ultimately this fiscal spending plan that's coming down the pipeline. Okay, so it's going to push yields a little bit higher, and as a result, equities should extend on yesterday's lows. The consequent, the other side of that flip coin is if we do come in at 48s, 49s, well, guess what? That's going to heighten the odds of a recession in the US. Okay, so it's a damned if you do, damned if you don't for the equities. I suspect they're going to go down either way. Okay, it is very much a case of the technicals now are in play, particularly in that S&P. We broke below that 59.25, which was acting as a really good support line. You get 59.25s by luck or chance today in the S&P. Hold on to that damn puppy because you got a decent downside reward on that. Okay, with that in mind, of course, we get above 59.25, the thesis is off. Okay, we get above 59.25, we're probably going to go back up to 6,000 in short order. But the reality is now, I suspect we've turned. I suspect we've got some significant downside coming in, and that correlation with the bonds is what you want to pay attention to. Okay, that is it for today then. Of course, there's a number of things going on. We also have initial jobless claims, which is always one to watch because at some point that's also going to give us a surprise tick to the upside as we do head into an economic slowdown. But of course, we do get that data point week over week. Now, if there are any other questions, do post them in the Discord. As always, if you like the content, like and subscribe, comment. We do appreciate the comments, and we do, of course, respond to your comments. So do make sure you comment in the section. Otherwise, good luck out there today. Manage the risk. Go make some money.